You know, an earnings report is supposed to give you a clear picture of a company, right? Well, Xcel Brands just dropped one that tells two completely different stories, and honestly, they don't make any sense together. So let's dive in and figure out what is really going on here.
Okay, so on one side of the coin, you've got a total disaster. Revenue just cratered, down a massive 55% year over year. I mean, that's a huge miss. But then you look at the other number, and it's a solid win. Their non-GAAP earnings per share, which, is just a way to look at profit without some of the one-off accounting stuff, actually beat expectation.
So, what gives? How on earth can both of these things be true at the same time? How can you miss your sales numbers by that much but still come out ahead on profit? That's the mystery we're going to solve right now.
All right, to get to the bottom of this, we actually have to rewind a bit. The answer isn't in this quarter's numbers. It's in something big that happened last year. And that one decision, well, it's the key to cracking this whole revenue puzzle.
Here's the secret sauce. It all comes down to one thing. Last year, Xcel sold off its Lori Goldstein brand. So when you see that 55% drop, you're not comparing apples to apples. You're comparing the company today to the company last year when it still owned a whole other business. It's a totally skewed comparison. So what happens if we fix that? What if we pull the Lori Goldstein numbers out of last year's results to get a real, fair comparison? Well, the entire story just flips on its head. The brands Xcel actually kept, their operating profit, or what's called Adjusted EBITDA, didn't shrink. It grew by 45%. The core business isn't dying, it's actually getting stronger. Okay, so that takes care of the confusing past. But what really matters is the future, right? And this is where it gets interesting. Xcel isn't just trimming the fat. They're going all in on a brand new playbook, and it's all about harnessing the incredible power of creators. They're calling it a working capital light model. That sounds kind of jargony, but it's actually pretty simple. Think about it. Instead of spending a ton of cash designing products from scratch and then sitting on mountains of inventory hoping it sells, they're doing something way smarter. They're partnering with huge established creators and just licensing their brands. It's a game changer because it slashes their financial risk and frees up a ton of cash.
And the big question is it working? Well, you tell me. At the start of this year, their brand partners had a combined reach of about 5 million followers. Not bad. But today, that number has skyrocketed to 43 million. That's not just growth, that is an absolute explosion in their audience. And it's all thanks to this new creator strategy.
So who are we talking about here? These are big names, household names. You've got the one and only Cesar Millan, the dog whisperer for pet products. You have food world superstars like Gemma Stafford and Jenny Martinez jumping into kitchenware. And even supermodel Coco Rocha for a beauty line. See, it's not just about getting more followers, it's about smartly moving into totally new areas by partnering with people who are already the go-to experts.
And trust me, they are not stopping there. They're thinking way bigger. Their long-term goal is to build a whole portfolio of brands that together have an audience of over 100 million followers. That tells you everything you need to know. They are completely 100% all in on this creator-driven future.
Now, a great strategy is, well, it's just a great idea on paper if you don't have the money to actually make it happen. So let's talk about the money. How is Xcel funding this huge shift? They've been busy building a financial runway, and it's pretty clever.
One of the smartest things they did involves their debt. They set up something called PIK interest, which stands for paid in kind. All you need to know is this. Instead of burning through cash every month to pay interest on their loans, that interest just gets tacked onto the loan itself. Why is that a big deal? Because it means they get to keep their cash and pour it into growing the business. And they can do this all the way until March 2027. It's like hitting the pause button on a major expense.
But that slick debt deal was just step one of a three-part plan to get their finances in order. So you have the debt deal to save cash. Then you have some really aggressive cost-cutting to make the whole operation super lean. And finally, they raised fresh money with a new equity offering. This wasn't just random stuff. It was a really deliberate, coordinated plan to give their new strategy the fuel it needs. And when I say aggressive cost cuts, I really mean it. They've gotten their annual operating costs down to under $10 million. For a company like this, that is incredibly lean. It shows some serious financial discipline.
Basically, every dollar they have is going into growth, not into fancy offices or big corporate overhead.
All right, so let's recap. We figured out the weird numbers from the past. We know the new creator strategy for the future, and we know they've got the money to do it. So, what's left? The final question is, what happens now? What are the big milestones we should be watching for as they try to get to break even?
Well, management has made it crystal clear. They've drawn a line in the sand. Their number one goal is to get to the point where they're basically breaking even on a monthly basis by the end of 2025. If you're following this company, that is the number to watch. It's the ultimate report card for this whole turnaround.
So get your calendars out. Here are the key moments coming up. The first massive test is this holiday season. That's when we'll see the big brand launches from Cesar Millan and Gemma Stafford. Hot on the heels of that is their big end-of-year break-even target. Then, watch for their presence at trade shows in early 2026. That'll tell us a lot. And it's all building towards that big date in March 2027 when that special PIKE interest period comes to an end.
And that brings us right back to the billion-dollar question, doesn't it? The strategy looks solid. The money is in the bank. But at the end of the day, can all this incredible reach? We're talking 43 million followers and counting. Can that actually be turned into real sales, real profit, and real returns for investors? That's the test, and that's the story we're all going to be watching unfold.